Hello, Providence Financial friends and family. Anthony Sicaro here, founder and president of Providence Financial and Insurance Services located in Woodland Hills, California. I'm also host of the Providence Financial Retirement Show, which airs every Saturday on AM 870. KRL Lays the Answer. And if you haven't checked out our new podcast, check that out. You can search for the Providence Financial Retirement Show on your favorite podcast player, or you can find us at providencefinancialpodcast.com. Now, I put these videos out for my clients. So if you're a client of ours, thank you for your trust. Thank you for your business. And we've had a couple of you ask some questions recently about what's going on with the stock market. And are there any changes that you should be thinking about making with all the volatility that has come upon us within the last few weeks? And I want to take some time and address that. As a matter of fact, there are really two issues I want to address. I want to just talk about the stock market very briefly. I want to talk about inflation very briefly. Both of these as it relates to you and your portfolios, the type of income producing investments that you guys have. And then I want to talk about what changes, if any, you should make. But I think we're at a point in time to where it may make sense to make a change, and this is going to be individualized. So we'll talk about that at the end as well too. But first, let's touch on the market. Well, the Dow Jones is now down 12% off of its all-time high. And the S&P 500 is down 17% off of its all-time high, rapidly approaching bear market territory. And the NASDAQ is over 27% negative off of its all-time high. I think that was back in October or November of 2021. So it's certainly been the laggard of everything. But the S&P 500 is really the most common index, the more reliable index, because there's 500 of the biggest companies in the world, and it is rapidly approaching bear market territory. And I think there's no question it's going to get there. Does it mean that I'm right? No one knows, right? If we knew exactly what to do, then we'd all be rich and you wouldn't be watching this video. So no one knows, but I think that we easily get there at some point. We certainly have a downward momentum, but we don't know. So how do we deal with the volatility that we have? And is it good or is it bad? And some of you might be thinking, well, what do you mean? Is it good or is it bad? Well, if you're invested for growth, then volatility is not great, right? The reasoning is because the value of your portfolio, the performance of your portfolio is going to depend on share price. And if the stock market drops and the share price goes down, then you've lost money. But you have to remember, we're not invested for share price. We're invested for interest and dividends, right? So if you're getting interest and dividends, what you have to remember is that if you're spending those interest and dividends and you're living on the interest and dividends, then it doesn't matter what the value of your portfolio is. So if you have $1 million portfolio and it's giving you $40,000 a year of interest and dividends, and you're spending that $40,000 a year, then your $1 million could drop to $800,000 and you still get your $40,000. Or your $1 million could go to 1.2 and you still get your $40,000. So if you're getting income, as a lot of you are, the fact that there's all this volatility doesn't affect your income. And it's also important to remember that a lot of you have investments in there that have maturity dates. So even though they've dropped in value, as long as you hold them to maturity, you're guaranteed to get your principal back unless the investments go bankrupt. And we haven't had that happen, and we're not anywhere near close to having that happen. So some of you, a majority of you, have a chunk of your portfolio that has gone down in value, but is truly just a paper loss because you're going to get some of it back when those particular investments mature. But if you're getting your income, the key is that your income is still going to keep coming in regardless of the value of your portfolio. So portfolio volatility doesn't affect you at all. No reason to get worried. Now, what if you're reinvesting your income? Well, if you're reinvesting your dividends and interest, then the question is, what would you rather do? Would you rather the portfolio go up, so now you got to reinvest when prices are at a higher price? Or would you rather your portfolio drop in value so that you can get a discount on the investments that we are now buying as we reinvest your interest and dividends? So the reality is that when a portfolio goes down in value, you get to reinvest at a lower price. So when it comes back, you actually come out smelling like a rose. So it actually helps you if you're reinvesting your portfolio. It helps you that the markets went down. You know, it's funny. I was having a conversation with someone last week that got this concept, and we were talking about real estate. And he had a pretty significant real estate portfolio, and he was asking me, where do I think that the real estate market's going to go? And I said, I could see us having a 20% correction, maybe even a 30% correction in the market. I could see that happening, but I don't think we're going to have a 50 or 60% real estate correction like we did in 2008. And we talked about some of the reasons why. But his answer was very telling. His answer was, you know what, Anthony? I would love for us to have a 50% crash in the real estate market. Why? Because he's got cash set aside. He's waiting to buy more real estate. And even though it means all his real estate would drop by 50% in value, his rent, AKA his income, is still going to come in. But because the portfolio, because his real estate dropped in value by 50%, now he gets to buy another piece of property at half off. And his response, I would love for my real estate to drop by 50%, was exactly the right response when you're invested for income. Because when you're reinvesting your interest and dividends, the further down your portfolio goes, the more you get when we reinvest those interest and dividends. And the real estate market's not going to go down forever. Your portfolio's not going to go down forever. Nothing goes down forever. Nothing goes up forever. So enjoy the time. If the market and your portfolio is down, most of our clients' income portfolios are down by 8 to 10%, somewhere in that range. If that's your case, and you're reinvesting, just know that you're taking advantage of it. The best thing that could happen to you is it stays down for a couple of years so we can reinvest for a couple of years, okay? Couple of years. So the market is off. The S&P is off by 17%, rapidly approaching bear market territory. A lot of your portfolios are down by only 8 or 10%. By the way, that's only 50% of what the market is down. So our portfolios and your portfolios are much more conservative than the stock market. So I think that's important. But you continue to get the dividends. Now, I believe at this point in time, and if you've watched any of my live TV interviews recently, you've heard me say this. And by the way, if you want to watch those interviews, they're all on the front page of our website, providencefinancialinc.com. You can go watch them. But you've heard me say that you need to be investing now for what you can count on. If you put money in the stock market today, can you count on the fact that in 10 years from now, that money is going to be worth the same in 10 years as it is now? Answer: no, you cannot count on that. If you put money in gold today, can you count on the fact that your gold's going to be worth the same in 10 years as it is today? No, absolutely not. How about real estate? No, definitely not. The reality is the only thing you can count on in a volatile market like today is income, your dividends and interest. The 3 to 4 to 5% that you all are getting, that's the only thing that you can count on. So you need to be able to invest in what you can count on. And again, if you're living off the interest and dividends, it doesn't affect you. If you're reinvesting the interest and dividends, a down market like this and volatility actually helps you. So that's my comments about the market in relation to your portfolio. Let's move on and talk about inflation. Inflation is where we might have to make some changes. Up until recently, inflation had been 2% or less. The Federal Reserve had been that had been their target for the last 12 or 13 years, trying to get inflation to 2%. And then in January, it crossed over 7%. And then the year over year inflation numbers for the end of March, I don't even know what it was for the end of April, but for the end of March was 8.5%. So we're hovering around 8.5% inflation at this point. And initially, the Federal Reserve thought it was transitory. I actually thought it was transitory. It looks like it's going to be around for a little while. And I had told you in videos a year ago, if you go back and watch those, that if it looks like inflation is going to be around for a while, we're going to have to adjust. We're going to have to make some changes. So then the question becomes, well, what is the best inflation adjuster out there? What's the best inflation hedge out there over the long run? The answer may surprise you. because it's not gold. It's not real estate. It is actually stocks. Stocks that pay dividends particularly are the best inflation hedge over the long run. And because they pay dividends, the reality is that they give you something you can count on, plus the potential for an inflation hedge. Now, we have to be careful because if you add more stocks to your portfolio, you're taking on more risk. So if you want to adjust for inflation, then you really have to be taking on more risk if that is something that is a concern of yours. Now, if you don't want to take on any risk, if you say, no, Anthony, I'm not looking to take on any more risk, but I still want to offset for inflation, well, that means then that you have to find an investment that's safe or guaranteed that's going to pay you 8.5% a year, because that's what inflation is. So please, if you happen to know of any investment that is safe, that's going to give you an 8.5% per year return to keep pace with inflation, let me know, because I want to put that out on a video. The reality is it just doesn't exist. So if we want to try to offset inflation, we have to not only get our income, but we also have to put our money into things that give us the best shot of adjusting for inflation, and that is the stock market. And over the last 100 years, the stock market's generally averaged 9 to 10% a year when you look at, or when you include dividend reinvestment. So stocks are the only way to do that. Now, and again, the dividends give you that income you can count on, but then you've got the potential for appreciation, which is where your inflation adjustment is potentially going to come from. Now, the concern, and this is where it's going to start getting personal because every one of you is different. What I don't want you to do is just go run and put all your money into stocks. That would be a mistake. Okay. Why? Because a lot of you can't afford to take the risk. And some of you don't need to take the risk. Some of you have enough money to where if you get 4% or 4.5% a year without taking the risk of the stock market, you're fine. You're going to be fine the rest of your lives. Others of you, that's not the case. Others of you can't afford to take the risk. So this is where it's going to start getting personal, but I'm going to need your help. At this point in time, depending on your situation, I think it's a good idea to get some of your money in stocks. Now, a lot of you I've already had conversations with. We've already got some of your money in stocks. If we've already had a conversation and we've already put some of your money in stocks, I don't think it's a good time to add more. Most of you have between 10 and 30% of your money in stocks. And at this point, with the market only down 17%, and that's a healthy number, but most of you that have stocks got in when the market was down 10 or 15%. So that's not much further down than where it was when you got in. But if you don't have any stocks in your portfolio at all, then it's a good time to get something. How much? Small amount. Small amount means 10 to 30%. I want you to have something so that when this time period ends, and it doesn't mean it's going to be a month, it could end in a month, it could end in a year, it could take 2 years to end. We don't know, right? But when this time period does end, if you have somewhere between 10 and 30% of your portfolio in stocks, then that's going to help you adjust for inflation and something better than nothing, if that makes sense. So if you don't have any stock in your portfolio at all, then I want you to call me. Let's have a quick conversation about should you add some to stocks? And the answer for some of you is going to be yes, you should. And the answer for others of you is going to be no, you don't need to. So this is where you need to call me. Now, if in fact you have, if in fact you have money in stock already, and we've already had this conversation, you don't need to do that. But if you are adding money to stock, or even if you, or let me back up, I'm sorry. If you are adding money and you don't have any stock now and you want to put in a small percentage, or even if you do have stock now, what I want you to do is I want to make sure that you still have enough ammunition in the gun, still enough bullets in the gun, to where if the market, which is currently down, the S&P 500, 17%, if it goes down 30 or 35%, then I'm going to want all of you to get more stocks, because that is what we're talking about, buying low. So right now, those of you that don't have any stock in your portfolio, I think you need to add some. Those of you that have stock in your portfolio, hold off. But if the market does go down 25, 30, 35%, I'm going to put out more videos, and I think it's going to be a good time to get a little more into stocks at that point. So please call me if you don't have any stock in your portfolio at all. You're already getting a 17% discount now off the stock market. That's a good time to get something in. Meanwhile, we'll focus on dividends so you can know you can count on your dividends. So I hit a little bit about on the stock market, just where we are in the market now. We talked about investing in things you can count on, which is your income. You can only count on your income right now. That's what we're doing for every single one of you. And then finally, we just talked about how to help combat inflation. Okay. And we've talked about that. Now, there's one more thing that I'm going to throw in. And that is that some of you are realizing that you're a little more nervous than you thought you would be. We met, we talked about how we're going to invest your portfolio, and we made some decisions. And we talked about the conservative options, which had the annuity, and we talked about some of the other things, the moderate options, and we talked about some of the aggressive options. And some of you have some moderate and some aggressive in your portfolio. And now that the market is being as volatile as it is, you might be wondering if you made the right decision. You might be not sleeping at night. So the reality is, if that's the case, and I don't want that to be the case, but if that's the case, then a couple of you have already called me and said, hey, you know what? I thought I could handle it, but I'm just not able to handle it. What else can we do? And if you can't handle the volatility, you're not sleeping well at night, guys, it's not worth it. Don't take the risk. The annuities over here are ironclad, safe as the bank. And the reality is, we'll pay you, if you could set up annuities to pay you, over 10 years, my guess is probably 4 or 5% a year, maybe 6% a year. So, and some of you have called me and said, look, if I could get 4 or 5% a year and just get out of this nonsense and not have to worry about all this volatility, sign me up. That might not have been your attitude a year or 2 or 5 or 10 years ago when you became a client, but it could be your attitude now. So if that's the case, if you're thinking about just making some changes, call me, please. More than happy to get you on my calendar. What's the last thing I got to mention? The last thing I have to mention is whenever I put a video out like this, I get a lot of calls. I've just asked you to call me, so that makes sense. So I will do what it takes to get in touch with you. Sometimes I find myself calling people on my way to the office. I find myself calling people on the way home. Sometimes I'll be 8, 9 o'clock at night in my jacuzzi talking to clients. Sorry, these secrets of the trade. But the bottom line is I'll do what it takes to get you on the phone. But be patient with me as well, too. But we'll make sure that we get that, get a call in with you at some point in time. So hopefully that helps. Wanted to share some thoughts with you. Again, feel free to call me if you think you want to add some to your portfolio, or if you think you want to make some significant changes just because now you're realizing that the market and your portfolio is maybe a little more volatile than you thought. Look forward to speaking with those of you soon who call. God bless.